Okay, good evening guys. Before we start, as always, do the customary instant poll. Let's check if we can hear the volume correctly. That's on your screens now. Let me know if the sound's perfect, too loud or too low. Standard settings for me, so it should be fine for you guys. Okay, that's great, thank you guys. So this is the second part of how to build a strategy. The first was a lot of theory, and I guess this part is more the kind of implementing, executing your own strategy. I think the important point for me to put across in all these things is there's no point me telling you a strategy or a way of trading or even mirroring my style of trading. What it's all about is understanding yourself, how you interact with the markets, how you can then pick out elements from a fundamental and technical side that support you being able to get involved in the markets in a consistent way. So there is nothing new, I would say, in trading. It's very difficult to reinvent trading. There's just a different spin on, again, looking at your fundamentals and technicals and looking at the markets and seeing how you fit in. Because we all think differently, we all act differently, and that is the important part. So before I start, as always, the risk warning. Remember that spread betting and safety trading can carry a high level of risk to your capital, resulting in losses that exceed your initial deposit. Not suitable for everyone, so please ensure you fully understand the risks involved. The information and comments provided here under no circumstances are to be considered an offer solicitation to invest. Nothing arranged food investment advice. The information provided is accurate the date it is produced. Education only. The content of the webinar is personal opinion of the moderator at naughtytrade.com. The content does not constitute financial investment or tax advice. Intraday.com does not set any liability for the content comments made during this session. So I guess there's certain elements to use in a long-term and short-term strategy. It's very important when you're a trader that you understand the difference. Having an opinion is quite dangerous in trading. An opinion of what markets will do over 3 months, 6 months, 12 months, that's investing. It isn't trading. Short-term trading is picking up on them short-term movements and using your margin and capital, getting into trades and out of trades. So the basics for me, and no matter how you interpret data, you have to remember we all have access to that same data. So when picking the elements of your strategy, you've got to keep this in mind. A lot of people that use charts use candlesticks. So you should use candlesticks. Why? Well, every time you see a chart on the news, a Bloomberg chart, it's them line charts, and they look great. They illustrate big drops, but they're very visual. They're meant for that, to display a piece of visual information of what has happened. They're not for you as a retail trader to pick out the nuts and bolts of what's actually has happened. I think the whole point with trading in general, especially technical analysis, is that it's self-fulfilling. That if it looks like it should work, it will work. Or certainly be proved that it hasn't worked very quickly. So I guess once you've got your candlesticks, and you understand that you don't want to be an investor. It could be an investor for sure if you're on a long-term strategy. You have to understand that comes with overnight risk, other costs, other factors. If you want to be an intraday trader, and there's different ways of looking at it. Looking at the markets when they're open and when they're moving. A lot of people will think they need to look at very small time frame charts as like minute charts. And that's really just not the case. There's only so much you can do in any trade and only so much you can do in any day. And just by picking the smallest piece of data doesn't mean that you're more in tune or switched in with the markets necessarily. Again, you're trading on a spread for a start. So tick data and individual data isn't necessarily what's best for your trading. There's a combination of time frames which will help you get a balanced idea what the market can do when they're open, and then other time frames that can back up when you should kind of buy or sell or be involved. Again, it's all really about time in your strategy. Okay, it's all the theory we've gone through in the first part, all the ideas of why you should use indicators, oscillators, what may work, what may not work. Really, right now, it's like putting it all together. Now, when creating a strategy, there are certain things that just work. Now, there's plenty of things from a technical perspective, indicator, oscillator based, that have been around for a long time and you can use. Now, there's RSI, MACD stochastics, Bollinger Bands, moving averages, volume, Ichimoku clouds, ATR, parabolic design, Fibonacci. Yep, that's just a small handful. There are bespoke indicators. There are many different other indicators and oscillators that have their time in the spotlight. Things like market profile was around when I was a young trader. But realistically, for me, things that work because of that self-fulfilling nature and because I know a lot of traders use it are things like RSI, so the relative strength index. That is down at the bottom. Okay, so it's to defined boundaries where the market is overbought and oversold on that time frame. And that will be 70 above is overbought, 30 below is oversold. So very easy to understand. You correlate when it's low points on the chart, it's good buying opportunities, and the high points, is a sell. So I mean, again, you can just look here. So RSI at a low point, market goes up. RSI at a high point, market comes down. I mean, if trading was that simple, it'd be amazing, wouldn't it? All we do is look for these particular indicators and oscillators to tell us the market was going up or down. We buy or sell, and we make our money. Okay, but obviously the markets are not that kind. So Bollinger Bands are something else you see on charts which indicate those regions, but they don't appear outside of the chart, they're inside the chart. A Bollinger Band is two standard deviations around a moving average. So really, these are one of the two things. Fibonacci is something I use in all my trading indicators, strategies, and that is understanding what's happened in the past can help you predict the future. So in this instance, the market's gone from the high to the low 80% of the time. A strong directional move retraces to 50%. Well, there's a strong down move, goes to 50%. Here it is, 80% of the time that works. So again, using things that work time and time again, very important. So when you're creating a strategy, you need to know how you want to interact with the markets yourself. I mean, the way I look at the markets, the way other traders look at the markets, might not be the way you look at the markets. And that again is things like following the trend, buying low, selling high. I mean, that's down to interpretation. What is low, what is high? Where's value? Okay, key reversals. Reversing, the current trend and the current time frame. Things that have been buying suddenly sell, and things that have been selling people buy up. Again, great instance of gold today. I'm looking at the gold chart now. We've seen 1, 2, 3, 4, 5, 6, 7, 8, 9. We're in the 10th green hourly candle. Now, you just don't get to see that very often. No retracements on the bigger time frames. So is gold going to continue to go up, or is now a good time to sell? Well, this could be one of these trades where gold goes up in this last hour. Back to maybe 1,248, maybe above, and then sells off. Understanding, when the market is likely to do something. It's about being right at the right time, not having the right opinion. If gold's gone up for the last 9 hours, is that the right thing to do to sell it now? Will it actually sell on the 10th hour? This is where trading becomes very subjective and down to what you understand. You might be looking at daily time frames, weekly time frames, different reasons. But the trend is that gold has gone down over the last few years, significantly. But the trend right now is every low point is buying up. So what do you want to do? Do you want to follow the trend and buy into 9 candles of strength, or do you want to see a key reversal and then sell? Again, it's not so easy, is it, when you're talking about small time frames and trading in the very short term. So in the example of kind of longer term, kind of overnight trades, I mean, this isn't really what spread betting platforms are for. You're not really. I guess you can take longer term trades and certainly hold things for a few days, but you're not meant to hold things for days, weeks, and months. The whole point of having access to many different markets is to be in and out, to buy and sell. That's why trading companies make it easy to get a variety of markets and access to a lot of markets, and to be involved very, very quickly in and out. If you're trying to pick a trend in gold or the euro dollar or Apple shares, that there are different ways of doing that. I guess the overnight make you a different trader. If you hold overnights all the time, you are different. You're a different style of trader. You're aware of the long-term risks, and you trade in different ways. Now, for me, things like Fibonacci, Bollinger Bands, Moving Average, and RSI are never out of place on any chart, on any chart, on any time frame, because they're all based upon what's happened in the past. What's happened in the past can help you predict the future. But you're either doing one of two things. If you're looking for that longer term trade, you're following the trend, or you're looking for that momentum breakout based trade where something has changed. So an overnight, again, what do we see in this chart? The market's gone down, retraced to 50%, which is about here, and then it hasn't made a new low. So really, it could easily go on to make a new high. Yeah, that's just a basic, just from years and years of trading and charting. That's what I would say. So you identify the trend. The trend is up. Buying opportunities, because you want to be buying in a market that's going up. Look at the moving average. Yeah, you're looking for rejections to close below that moving average, and the market then to find strength. Fibonacci. Again, as we've said in the past, what goes up will come down, and we can use the past to predict the future. Bollinger Bands show you areas of support and resistance, or again, like RSI, overbought and oversold. and that again, the RSI will show you when the market is at a low and the high. Then you find the momentum and you trade. So again, these are daily candles. So you're holding your trade for at least a day. So the market has come down very aggressively here, got back to 50%, and that 50% has really acted as support. Again, with the RSI moving up, with the Bollinger Bands moving average acting as support, you would expect this market to make a new high. So what's that new high? Well, you just go back to where you draw your Fibonacci from. The market is looking to get back to here. So what you're looking to do is to buy bounces. So the market to bounce back and get up to these high points. Again, that has taken. If you look at the up move, it took a lot less time to go down than it did up. So down maybe 15 days, up, to make some profit, only 4 or 5 days. Then eventually we get up high, but then we sell, come up, we go down. The waves that you always see. But you have to understand where you are in the bigger picture if you're looking for the overall trend. Yes, the market's been up here, which you're looking for it to get back to. But when it found it last time, it came down very, very quickly. It then had to struggle to get back up. Had one fake out here, but it's getting back up. So you want to be buying it down on the low points. You want to be buying it here or back at that 50%, looking for it to bounce and make new highs. The whole point is what you don't want to do is take too much pain on. You don't want it to buy it here, because that's a good point. Then the market ends up going down here before it then makes a new high. Again, all when you're buying and selling, all these areas, the market's been here before, but they're all areas of pain. Okay, so if you see the market back at any of these points down here, yeah, you've had pain, because what you want to do is figure out when the market's reversing, going to get back to where it has been, yeah, and buying it as low as you can in order to make profit. So again, what we're looking for is momentum, to stop. So we've seen the overall trend, the bigger picture stuff. So we're looking for that down momentum currently to stop. We're looking for the RSI. Again, good point. We're looking to get down to the 30 area where the market assumes that we're oversold. We're looking for the Fibonacci bounces, those key levels, the 50%, 61.8, and then they want them to find, Bollinger resistance and support areas around here and buy into that overall trend. So as the market's gone down, yeah, the RSI has gone down. So we're looking for that to level out. We're looking for the areas of Fibonacci to be support, the moving average to act as support. And although the big moves are down, which they are down here, down here, down here, yeah, it's getting smaller. The selling momentum is running it out of the market. So what we're looking for is that momentum to stop, find the right point, and to buy it up, make the markets go higher. So I guess, using short-term trades for long-term trades is the same. So what we're looking for is that overall daily picture, and then to use the smaller time frames to get involved. So instead of a daily time frame we're looking at, this is now an hourly. So we all know that the overall trend, is up. We've established that there was a big down move, but the market's buying up. We understand that we need the short-term down move to stop, so we can therefore buy low. We need to zoom into the hourly chart to find a decent entry, and we use the overall trend, all the tools we've seen, Bollinger Bands RSI, and again, marry them up with the same Bollinger Bands RSI, but on the hourly charts, and try and find out, what is a low point, what it is. So what we're looking for is key levels, to buy low. That's all we're trying to do. We understand the higher time frame, and we understand, what the shorter time frame we do. We're trying to marry them up and understand, where we buy value. And I guess that the same thing works for exit. A lot of people forget that when you're looking for support and resistance, they're not truly support and resistance. For me, it's all about understanding what happened in the past and what happened in the future. So what happened in the past will happen in the future. So support and resistance was support, and it'll then eventually become resistance. Resistance will come again around to be support. So it's all about understanding that the points of interest. So what happened in the past will happen in the future. So when you look at different charts, understand that if you take the longer term trade from the daily and then look at the weekly levels, for instance, for your exits, you're going to get a bigger picture. So what you should do is look at the higher time frames monthly and draw in what was support and resistance. Look now what's support and resistance. What was support and resistance in all the time frames, and then try and use it on something that's going to help you. So this is the weekly. So right now we can see these are areas of support and resistance. So they might be important on your daily chart. They might also be important on your hourly chart. Again, the whole point is markets have been up and down on the weeklies. So these points where the market turned on the weeklies are more important than dailies because more things have happened, more pieces, of information. So I guess long terms and overnights, when you've looked at them key reversals in the current time frame and trend, and you're looking for pure signals and levels to trade, the momentum is going to change. Okay, the market conditions don't stay the same for very long. As we've seen in the markets right now, very, very difficult to trade. What you're looking for these trend tools and oscillators is to pick the markets that change, okay, but then fit in with your view. Now, no matter what you trade, what's happened in a monthly chart, weekly chart, daily chart is set in stone. It cannot change. What will change are the open time frames, 15 minutes, hourlies. Okay, dailies will close, hourlies will close, but a day is set in stone. An hour, again, is liable to move. So I guess what we're looking for is to look at them monthly, longer term trends. Go into the weeklies, okay, and then the dailies. So figure out what the market's trying to achieve. Yep, market's going up, which is great. However, we're hitting a high point in the RSI. Weekly, we've kind of double topped out, and we can see that we're looking to come down in the in the weekly smaller time frame. But on the dailies, we're not looking anywhere near as bullish as we are on the monthlies. Again, we've had this area here where the market's topped out and bought, and we're actually now coming down. So it's figuring out what's happened in the past, and what can happen in the future, and you can only do that from what's actually been recorded. And again, when you're doing things from a technical analysis standpoint, a monthly close is a monthly close. It is all them 15 minutes, hourlies, dailies, weeklies, it's all that data put together, okay, in a divine point of support and resistance, which you can see, which can't be changed. And again, the weekly is still very strong. Your dailies become a lot more susceptible to what can change with the current fundamentals and technicals, and then your hourlies again are probably what you trade off. So again, if you put all these things together, from the monthly view, you can get the overall trend. You can see really good support, really good support resistance, and you can see again another good trend. But the whole point is you're hitting the upper Bollinger Bands, the upper RSI. These things in monthlies take a long time to filter through, a long time. So just because you see an upper Bollinger Band hit or the RSI hit a point doesn't mean it's absolutely imminent. It will happen for sure, but it might not be in the next 15 minutes or hour. Again, it's all about figuring out that time factor. And then you go to your weekly view. It's not quite the same, is it? You're not seeing that very, very strong uptrend. Okay, what you're seeing is the market actually topping out and then breaking through support and looking to move lower. And then the RSI, the Bollinger Bands are supporting that. Then when you look at your daily, you're looking even more negative. Oh, sure, the market's going up, but we've broken support again, and now again we're seeing much more red candles than we are green. So you're expecting that weakness to come into the market. So again, it's averaging into short positions, taking advantage of the overall move is fine, it's great, but it's picking out what's happened in the past and understanding that's relevant to your trading now. What you don't want to do is look at too high a time frames and be caught out, because even being a long-term investor, if you're trading small size, things take a long time to move. Okay, these huge distances. So time is a really big factor. So really what we're looking for is an overview. Is you're building up your strategy thinking that, the monthlies, definitely bullish. But that must be coming to an end because the weeklies, again, have broken these double tops. The RSI and Bollinger Bands are telling me that, this strength is coming out of the market. And get into the dailies, okay, well, I don't want to sell here because the market actually goes up and might squeeze me out of a short position. But then after that, it comes to break and then the selling happens. Okay, so it's one of these key phrases in trading. If you spotted a trend, it's already too late. So you don't want to be selling, okay, at the absolute wrong point. And that on the dailies, again, can be quite misleading. You think this is an absolute top here. You think, yes, this market is definitely going down. Well, it does. But then really it comes down and then goes back up. So you can get stopped out before the true move happens. So again, it's that element of timing that's important. So a short-term strategy is really what I think intraday trading is all about. I mean, that is the very definition. Trading when the markets are open, looking for highs and lows, looking for movement. And that, again, what you're looking for is to use them higher time frames, your monthly, weekly, and daily, but then get involved in smaller time frames, your hours, your 15 minutes. So use that short-term volatility in order to get in and out of the markets. So remember, 4 15-minute closes give you an hourly signal. So you don't have to necessarily trade off the monthly, weeklies, and dailies. They can be targets that have happened in the past. Okay, and then in the future, you're looking at smaller time frames that build up to things that are very important, like the hourlies, and then figure out how you trade that in the short term. So again, indicators and oscillators, different ones will suit your needs. Okay, there are benefits and drawbacks of them all. All indicators are pretty much lagging. They're taking a period of data, a period of signals, and then giving you an idea how that curve or how that data interprets. An indicator, an oscillator is an indicator. An oscillator is just a scale between 0 and 1 or 0 and 100. So it gives you an idea of how support or resistance, overbought, oversold a market is based upon a number. Whereas indicators are much more visual. They'll give you a dot or a line based upon the actual chart itself. So, I mean, this is a gold chart. So the long-term trend is bullish. Yet in recent months, gold has sold off. I mean, this is how all this presentation is. If you're looking for shorter-term volatility, then you need to look at the correct time frames. If you're not holding overnights, then hourlies and below will give you the strongest opinion of what the markets are doing. I mean, again, these are very reminiscent of today's gold charts. The markets find ranges and then quickly buy up and then take a long time to sell down. Whereas, the opposite was the case, 3-6 months ago, where the markets found it very difficult to sell off, to buy up and sold off very, very quickly. So that's how trends can change. So what we're looking for is the shorter term to figure out, what's important. So we can see from the hourlies, the markets, attempted to go down and had a big up break. Again, we've probably come nearly to that 50% of a strong directional move trades to 50%. So the thinking is that if it's still a bull market, then gold will go back up. So what you're looking at is really trying to figure out, and fade out the noise. So if gold is a buy, you want to be buying low. So the Bollinger Bands tell you here. Again, we get a support on the moving average. And although we break here, the market is still very, very strong. So again, it's all these things on the charts are telling you areas of interest. It's more for me sometimes what's not happened. What's not happened is very much here. Nothing really has happened. The market has failed to break down aggressively in an uptrend, then rejected it here, and then gone even further up in the opposite direction very aggressively. Okay, so the Bollinger Bands, the moving average, have told you that okay, it takes a bit of time, but if the market can't go down, then it wants to go up. So when it gets back to a level of support resistance, what it wants to do is then move aggressively. And you see all this noise previously in the chart, but after that, you see big buying movements. So again, 14 period and 20 period, moving averages, again, they give you an idea of what's happened in the past. So in the past, the market really has moved sideways, but when it's rejected going down, it's found support and gone back up. Okay, so what you're looking for is opportunities to buy low. So the RSI will give you a good idea of that. If you zoom into even smaller time frames, maybe the 15-minute or 5-minute candle, you can see that as the market goes down, it does look, kind of fairly strong. We get a breakout of the trend here, but the market, when it wants to go back up, again, it does. So what you're looking for is these low points in the RSI where we're oversold to buy low, yeah, and the market does go higher. But then conversely, when the market wants to break out and it's overbought, it can come lower. So again, all these things tie up. It's being right at the right time. That is the problem. Not trying to be, a little bit too clever with these things. So the short-term hourly and the 15-minute charts again are a great combination. You can see that the RSI is looking weak here, and the market's topped out in the hourly. So what you figure out is, well, how's that going to look on the time frames I can trade? Well, the 15 minutes the same. Okay, as it really picks up the RSI to the very high point, that correlates with the 15-minute chart, but takes a long time to go down, doesn't it? It's moving down, but probably not as quick as we like. We'd like to drop like that, but it doesn't happen. But as the RSI moves down, so does the market. So you pick a signal from the hourly, you look in your smaller time frames, and again, you might just sell every high. But if you sell every high here, you're making 15, 20 ticks, 15, 20 ticks. So you do that for the next 3 or 4 hours, and you're making hundreds of ticks. That's a strategy. That's how you trade. So again, what you're looking for is it's always areas of interest, and then what's going to happen will never happen when you want it to. That's unfortunately the way trading is. Market goes up, sideways, up, and you think to yourself, well, it's got to come down as quick as it came up. Well, it doesn't. What it actually does is gives you a signal that it has topped out, but then what you've got to do is be patient, and then you sell your RSI, you sell your moving average, you sell your Bollinger Bands, and eventually you might get a breakdown. But it's small trades based upon high probability ideas of what's happened in the past. And your RSI, yeah, is a great, factor in this. Every time things go up, come back down. I guess less is more. If you put every indicator and technical tool that I mentioned initially, you have a chart that looks like this. You've got your Ichimoku, you've got your parabolic ZARs, and it doesn't tell you any more. I mean, I would say RSI, Bollinger Bands, Fibonacci are a good place to start. Then you get an idea of what is high, what is low, and what is high and what is low is relevant to the time frame what you're trying to achieve. And again, if you're a short-term trader looking to get involved in maybe the 15-minute or hourly, highs and lows or candles or momentum breaks up or down, if you're a long-term trader, again, you might have to go back to your dailies, your weeklies, your monthlies to hold trades for longer. But again, then you have to be more patient and you have to, wait for these bigger swings when you're a long-term trader. A short-term trader, you might only looking for 20, 30 pips, okay, where a market can move 3, 4, 500 pips in a day. Again, it's not about being right, it's being right at the right time. And with, the right amount of capital and money, you can make just as much money in a day as you can by holding a trade for a week. So that's how you put it all together, really, from the kind of more practical side, from the technical side. Now, the third part of the course is any of my live trading sessions. So there'll be a live GDP towards the end of the month, and I'll show you how to do these things in real time, trading around data. Any questions, guys? Any thoughts? Anything you'd like to ask on what we've gone through tonight? Remember, all these sessions are recorded, so you can go back and revisit them. The first part of the course is all about the theory of getting a trading plan, a trading strategy, and what's right for you, understanding yourself in the markets. Then the second part is all the tools you can use. Now, obviously, there's a big part which is fundamental, and that is what drives the markets by new news, comments, etc., etc. But again, you have to be, aware that these things work in unison. I would say 8% of the time the markets are really trading in a technical fashion, and then 20% of the time is due to any kind of new news. So any final thoughts, guys? Any final questions? No, my pleasure. Well, again, anything else, guys, get me on Twitter at Steve Ruffley. As I said, there'll be a live trading session towards the end of the month. I'll just check the date, actually. That will be GDPs at 1 o'clock on the 26th. And plenty more webinars and lots more to talk about. So anything else, get me on Twitter at Steve Ruffley, or my email address is sruffley@tradermaker.com. Right, guys, well, hope you enjoyed it, and I hope it's been a good introduction to the kind of more fundamental side of building your long or short term strategies. And again, it's all about finding what's right for you, isn't it? Again, it's not about taking somebody else's strategy. It's finding out what works for you, the elements you understand, and then trading it accordingly. Right, guys, thank you very much. Have a great evening. I'll speak to you all soon.